Hello, fellow investors. Welcome to another episode of Ritter On Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Ellie Perlman. I think Ellie's got to be one of the smartest people in real estate. I've followed Ellie for a number of years. I mean, probably 5 years now. I've known you, and you've provided me some great advice at certain times in my career. I've always been very appreciative of that. So super excited to have you on here today. Little quick on Ellie is she is the CEO of Blue Lake Capital Group, and she specializes in multifamily acquisitions and management. I think largely throughout the Southeast. I know Ellie has rapidly grown her business. I think anything I quote will probably be old numbers, so I'll let you fill folks in on that. And just with that, we'll get right into it. Ellie's so happy to have you on the show today. Thanks for coming on.
Yeah, absolutely. It's a pleasure being here, Kent. I think we bumped into one another. I think the last time I saw you was a few months ago at a conference, but
Mhm.
we've known each other for years, and it's always great to see, your growth. But yeah, we're multifamily owners and operators. We've had about 850 million in acquisition in transactions, and we're probably going to in a few months or so we're going to hit the billion dollar mark, and we're focused mainly on Class B assets in strong areas, um Texas, Florida, Georgia, the Carolina, but also Arizona. And so the Sun Belt is one of the areas that we're focused on.
Gotcha. I love that. And yeah, I mean, that's kind of right where I wanted to go with questioning. I mean, really just want to, somebody with your deep expertise, really want to pick your brain on how are you looking at things? How are you looking at investments? Why are you investing in the things you're investing in? And really give our listeners who are, newer or getting started and want to develop their own thesis some insights, right? So I think to start is we talked about your B class in A areas, right? In those great areas. And the simple question, why did you pick B, and why your focus on the particular areas, and maybe even into talking about some of the markets that you're in, and then as you dig into like your sub-market review.
Yeah, absolutely. That's a great question. Coming from MIT and being a former attorney, I always look at trends, at data, and trying to make decisions that are unrelated from any of what's popular out there in the market, and what feels good. So I'm trying to take emotions out of the analysis and decision making process. And I know it was very, very popular to invest in C-class assets 5, 10 years ago. And I tried I thought, why is that? Why is it so attractive to investors? And the answer was that there was a tremendous growth in that asset classes back then. And that attracted a lot of sponsors and limited partners, investors. They bought it at a much higher, discount compared to Class B and Class A assets.
Mhm.
They were able to push rents, and those assets were cash flowing. I never thought that that was sustainable. And looking into the numbers, and I was fascinated with what happened in 2007, 2008. And I believe that what really was responsible for that growth in C class, in C assets, are those tenants or homeowners that lost their homes back in 2007, 2008. Now, where are these people going to go? They lost their homes in the big, crisis that happened there,
Mhm.
and they could only afford going to Class C. They cannot afford the rents of Class B, let alone A. And that spurred the demand and kind of pushed people to those asset classes. But my understanding was that my projection was that once the economy shifts, these are going to be the first ones to be in distress because those tenants were not going to be able to pay their rents. And so I never thought that the premium was really worth it. And my focus was on Class B, where you have tenants that have steady jobs, that have well-paying jobs that can withstand at least a big portion of them any shifts in the economy. And we all know that during COVID, Class C, got hit pretty significantly. It's a kind of a blanket statement, not all Class C assets, but some of them. And Class B actually fared pretty well. And when cap rates were so low at 3%, 4% in some markets, the price per door between Class C and Class B was really not that significant. And so what is the risk that you're basically taking some risk? The cap rates were not that meaningful in terms of, the difference between Class B and C. And I remember looking at, I usually do not look at old assets, but it was in Buckhead, Atlanta, really strong submarket, very strong population, but the asset was 1969 and it was sold below 3 cap. And I thought that was crazy.
Wow.
And
that is crazy.
It is. And they had, they still had wallpaper on some of the units because just tenants never left since the 70s.
Yeah.
One of those unique, assets. But that's why, to your question, I focus on Class B because I see that, I see the demand there, and it brings certain tenants that you want to keep and that can pay rents even when the market shifts. Same for Class A, but Class B has that sweet spot where you can still renovate, push rents, and grow the property's income. So that's why I focus on Class B. Now, the second part of your question was about the markets. And so we basically follow the migration within the US. And so people basically left a lot of the core markets and moved to more affordable markets, warm markets, whether it's Arizona, Texas, some movement to Florida, North Carolina, South Carolina. It's more affordable for young families, for millennials and Gen Zs. And so basically we're focused on where the migration is because that basically brings the demand to our assets. And usually it goes hand in hand with job growth. So you have a lot of companies, we all know about the Research Triangle in North Carolina. And so these are the markets that we're basically focused on. And we're looking at specifically neighborhoods and submarkets that have tenants that work in industries that are pretty solid industries, like, for instance, education, that are less impacted by recession. So whenever the next recession is going to hit, those tenants are less likely to be impacted by the changes in the economic environment.
Gotcha. No, it makes a ton of sense. And so just to recap a little bit as I think about summarizing this, so it seems that from your perspective, when we talk a lot about risk adjusted return, right? And not just looking at it either in a vacuum, but looking at them together. And it seems like that B class kind of hits that mark for you and that risk adjusted return side. I mean, your comment around the C and the low cap rates there that were there historically, at least over maybe the past 5 years, if you're going to have to pay that much, and there's a pretty small margin between what you'd pay for a C and a B, you might as well buy the better, newer asset that's going to have, less deferred maintenance and less ongoing CapEx, but also really locking in that higher level tenant base. It just sounds like you're really honing in on that downside risk, that what's the likelihood that that person would be able to pay is what that sounds like.
Yeah, that's about right. Yep.
Gotcha. And then, yeah, markets, I mean, everything makes sense. We have seen all the migration down into the Southeast. And I know that's been a big area of focus for a lot of folks. I mean, how do you the demand is obviously there and demand drivers are continuing. What are you forecasting around the supply side as you look at those markets? And how do you think about supply risk in some of the hotter markets where we know a lot of folks want to be? How do you look at that and how do you evaluate that as you look at deals?
Yeah, absolutely. So you can definitely see in some markets and submarkets that the number of new permits has been going down. I think a lot of the new constructions of multifamily is coming to an end. These are projects that started 2, 3 years ago during COVID when there was, very high demand, but also when the cost of labor and materials, went up. And there's much less excitement about building more apartments at this time. So we see a much lower number of new projects that are anticipated to be built around the assets that we're buying. And then you have those areas and submarkets where there's very high barriers to entry because the city is not allowing much of that activity. They want to maintain the look and feel of the town or the city, and it makes it much harder for developers to start a new building. And that's also good for us because you, as an owner, you want to buy where there's high barriers to entry, meaning it's very hard for other developers to build a new asset and basically provide attractive rates and concessions to lure investors in. So we had an asset that we've exited this asset. We've made over 20% net IRR returns to investors. But I learned firsthand how painful that could be when there's a new building next door and you say, well, they're probably, we ran an analysis, we said probably their rents are going to be, $400 or $500 higher, just to learn that we are bitterly mistaken and they are competing with our asset and our occupancy suffered from it. And so on another asset of ours, once we saw that literally across the street, a company was starting, I'm talking about years ago, starting to build a new asset, we knew that would be the right time to exit. And we did, and we made, solid returns to investors as well. But to your question, we've seen a downshift in the demand, in the supply and desire of developers to start new buildings. I think with the higher interest rates today, it's harder and harder to fund those projects, which is actually good news for Class B and actually to any class, owners of multifamily right now.
Gotcha. So what you're actually seeing is kind of a peak in the, I guess, new apartment delivery on the supply side, and maybe that's peaking this year, perhaps. And you've seen, looking forward in the future, new permits, you're seeing that down, at least in the markets that you're looking in, down within the Southeast. That's interesting. I didn't realize that. I think in some of the markets we look at, things are still kind of going gangbusters. So it's very interesting to understand market by market and the different dynamics of what's going on.
Yeah, some markets, you're absolutely right. But in others, we've seen the opposite trend.
Super interesting. So I love the thoughtfulness that you put into your approach. I think it's really valuable for the folks and our listeners to really understand how to dissect market, submarket, and even the reasoning behind. I mean, everybody has different approaches, but a very thoughtful strategy related to B and why that you're in B. And I think that's going to resonate with some folks. I know you've been doing this for, I want to say a number of years, like forever, but you've been doing it for long enough now. You've got a lot of experience. You said 850 million in transactions and going to hit the billion mark this year. So one, congratulations. That's fantastic. You've got a lot of experience there that we can learn from, and a history that's longer than a lot of folks that have just jumped in the last couple of years. And I guess the reason I do all that setup is because I want to ask you, from your perspective, how has your approach changed over the last year with all of the different drivers and events in the environment? I mean, whether it's interest rates, whether it's wars, I mean, everything, inflation, everything that's been going on. How has your perspective, if you're thinking back to like where we were in April or even maybe March of 2022, right? Things were hot to now, how has your approach changed or has it?
Yeah, it definitely changed. It was refined. It's not like I'm going after different asset class. There are two things that it has shifted a bit. The one of them is obviously is the debt. And most of our assets have been purchased with fixed rate, and then we have other assets with adjustable I don't know, bridge loans. And so in terms of a strategy, we only buy assets that work with fixed rate. And we love assumptions, which was
Mhm.
something that, 2 years ago, 5 years ago, it was not something that was very attractive because the debt was so good. But there's a lot of long-term, loans that you can assume right now. So you lock in 2.5, 3.5% for the next 5 to 7 to 9 even years. And so
Mhm.
that is very, very interesting to us. That's one of our main focus deals that we can assume very good loans. Um, and then the other part is looking at bad debt. And so if before, and again, the strategy changes as things change. We don't have a strategy and we stick to it for 10 years because things
Yep.
change. You need to be able to change with the changing conditions of the market. And so if, let's say 6 years ago, we would look at a deal and say, you know what, bad debt, which is basically all the delinquent rent that are being written off. If that's 6%, 7%, 5%, and usually it's not that high because it's a class B asset, but some class B assets have, they have higher bad debt. If it's, let's say 5%, when the normal should be no more than 2.5, I would say, we can change it. We can, improve the tenant base and evict
Mhm.
those who are not paying, and clean the property. And we've done that successfully on other assets, on some of them. Now it's not something that I would be interested in because
Mm.
once it's
Sure.
going to be a recession, then it's going to put more pressure on the assets that have a certain portion of non-paying tenants, and you want that number to be as low as possible. So when it comes to the debt and the bad debt, these are the two things, the debt structure and the bad debt, the two things that our strategy has been kind of adjusted recently, expecting the recession, assuming it's going to be harder for tenants to pay in the next few years, hoping that it's not going to be the case, which is why we're looking at strong markets,
Mhm.
but assuming that it will be an issue, and buying the assets that are more likely to not being impacted by the next recession.
Gotcha. No, I love that answer. I mean, it's really a focus on taking risk off the table, moving to fixed rate debt, which I mean, it's interesting, right? Because debt moves in cycles as well. As like
Right.
when I first started buying apartments, which was 6, 7 years ago now, it seemed like everybody was using fixed rate debt. It was you were doing agency fixed rate because you could get fantastic rates. And then as everything got hotter and hotter, there was this shift to the bridge loan because it was the only way to be competitive because you had to finance a lot of your capex, right? To be able to get that leverage. And those were the Wild West days of like 19 to 21. Now the smart people like yourself have come back around. And like you said, your strategy has to change based on the environment. You can't set a strategy 10 years ago and say, yeah, we're only doing this, that you're not going to have a successful business. So you've adjusted to the market and said, yeah, it makes sense to take risk off the table. right? Be able to lock into fixed rate. And similarly, we share a very similar strategy in that we're looking for those assumptions as well. I mean, as I think, which makes a ton of sense for those reasons. And it also seems to be the only people that are selling right now, they either have to sell or they've got a sweet assumption at a low rate that they know they can get a bunch of value out of. So some of that's driven by the sellers too. But yeah, I think that assumption play, getting into that fixed rate debt, um, is a great strategy because those assumptions can be a little more difficult to go after. And so you can turn off certain buyers as well. So they have some less competition for some folks that just don't want to deal with it. So yeah, I love to hear how you've evolved. And it really talks about how you're taking risk off the table. And while you said with bad debt, like you would have taken on more of a project several years ago, right now, with sounds like your thesis heading into potential recession at some point in time, don't want to take on that risk that bad debt only gets worse from there. Whereas I think, newer investors without that experience may say, oh, it's 5 or 6. I know the benchmark is maybe even 1%. And so we will be able to improve that. I think you've been through enough battles to know the reality and
Yeah,
know, if we're heading into a worse economic environment, it's unlikely you're going to improve your bad debt over that time period. So yeah,
that's
really
true.
appreciate that perspective. Well, awesome. So from there, I really wanted to switch. I wanted to ask you a few questions around
Yeah.
you've just done a fantastic job of building a true real estate business, right? And building out a strong team and really being able to scale what you were initially doing on your own. And so I know there's a lot of people out there that are really, maybe they're the solopreneur, right? Or they've got a group of friends that have gotten together and they're trying to go from being just themselves to really creating that sustainable business. And so I'd love to just pick your brain a little bit on some of those aspects and just start with, how do you approach as you looked at from what you were doing, let's say 5 or 6 years ago, right? And how that's evolved to where the seat you're sitting in now, and you think back of how you built that team out. And what was your thought process as you went through from like maybe just break it down this way. Who was your first hire and why? And then kinda how did you move on from there and say, "These are the seats I need to fill," and how did you go about doing that?
Yeah, my first hire was actually a personal assistant to help me schedule meetings with investors. Because when I started, the capital raise was my focus.
Mhm.
And I remember sitting in my living room. I didn't have an office back then, and I had the whiteboard behind me, and I said, "Okay, in order for this to become a true business, and I'm not going to be self-employed, what do I need to do?" And I started drafting all the different functions that I was working on. And so on one side, you had capital raising, you had asset management, and you had acquisitions. And many sponsors think in those three buckets.
Yeah.
That was not something, unique. And then I said, okay, where am I good at and where do I want to spend my time? And that
Mhm.
was I enjoyed, raising money for my deals and talking with investors. And I said, okay, I I can underwrite deals and I can manage the assets, but I don't enjoy that particularly, and I'm not a numbers person. So the next hire was an underwriter, someone who can underwrite deals. That's what they did for a living, and that was their strength. Their career was running, building models and breaking
Mhm.
them, and testing the assets. And so that was a second hire. And then once I had someone that was underwriting deals, then I moved to the third bucket, which was asset management, and I hired an asset manager. And so over time, those three buckets have grown, and I've hired more people to help with raising money and talking with investors, more people to help with acquisitions. And so we have teams of acquisitions team, asset management team, and investor relations and marketing team. And so it did not happen overnight. And at first, yeah, it's scary. Before you're making a lot of money, you need to spend money that you may not
Yeah.
have to hire people. But honestly, the opportunity cost of not hiring the team was just too great.
Hmm.
And so you're asking investors to invest in your deals. If you're not comfortable investing in your own business, and that says something about the 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 venture that you're running. And so it took a few years to build a solid team, and I went through the process of hiring people who were more junior, to realize that I'm picking up the slack a lot for these people, and that does not free up my time to grow the business, to bring in more family offices and more sophisticated investors. And that was a learning curve for me.
Mm.
That's not something they teach you in business school. You have to learn it on your own. So at MIT, I learned how to form a company and build it, and how to speak with investors, and how to build a strategy around your business. And all that was great, but nobody is saying, you know what, you think you can get someone junior, or someone who's willing to do the work for less. There's a reason for that. And
Yeah.
so I'm happily paying, right now we have multiple people that are being paid six figures, because they're the right people for the job. And having people that are not experienced or not the right fit, it will cost you a lot more than those six figures.
Yeah, absolutely. I couldn't agree more. And we're in a similar boat. We've got and I've definitely done, a little bit of the hire the junior, or try to go, a cheaper route, maybe find a
Yeah.
contractor here or there versus hiring the full-time person, and learned a lot of those lessons. I think your insight around I think what people forget about is the most expensive thing you can do is hire or fire someone. Those are the most expensive things in time and resources, money. So you got to find great people, and you got to keep great people. And at the end of the day, money is a big factor. How do you keep good people? Well, you got to pay them well and make sure they're appreciated,
Yeah.
right? And yeah, like the junior person, like I relate that. That's kind of like, when you will see these properties, like you see a C class or even a D class property, and on paper it's like a 14 cap rate, right? It looks fantastic. You're like, I'm going to make so much money on this, but the devil's in the details, right? And
Yeah.
it's like the same thing, I think, with that junior person, where it's like, yeah, this person could do this, and they're going to be, whatever, a third of the cost. But yeah, then what you've realized, it sounds like, is if you're not really getting the leverage out of them, and you're not freeing up your time, and you're having to still wear that hat, you're not
Yeah.
living your highest and best use, right?
Of
Which
course.
is
And you can't
yeah,
afford to not bring the top people to underwrite deals for your investors and manage
yeah,
those assets for investors. You can't afford to bring
yeah,
anyone below great. And
yeah.
that's what I've learned.
Absolutely. And that's one of the things I love about real estate is in my past life I'd manage big teams. And I mean, I'll be completely transparent that people management is not my favorite thing. It is a lot of HR. And so I love with real estate that you can do a ton with a small and mighty team. If you have the right
Yeah.
people, you can get huge leverage out of them.
Yeah.
Because you're not billing for hourly and things like that. We have to have lots of staff, and that's one of the things that attracted me to real estate. Because I love the idea of just having a small elite team that can do a ton, right? And so I think that's similarly what you've described in your experience of the ability, you don't need a ton of them, but the people you have, they have to be fantastic, you know,
Exactly.
and it's totally different hiring. It's very different hiring than for most businesses,
Yeah,
who are
exactly.
more hiring based on volume. So
You can
yeah,
outsource parts of marketing. You can outsource, parts of HR or IT. You
mhm,
cannot outsource asset management, acquisitions, these are too important, and you got to have someone who has tons of experience, knows all the details,
Yeah.
and is the right person to manage your investors' money. That's the most important thing.
Yeah.
Losing your money is one thing, and handling investors' money and losing someone else's money is a whole nother thing. And I've never lost anyone's money, and I hope that that's not that I never
Mhm.
will. But you really, by bringing the right team, you're lowering the chance that that's going to happen.
Yeah, I love that. I love that. And, I think one thing, a tip that I got that I always try to look at is, when I went to hire my team, it was trying to find somebody that's better than me at each of
Yeah,
those roles, right?
yeah,
And it being humble enough to admit that, right? I mean, I think a lot of people struggle with that. It's like, no, like the reason you're paying them so well is because they need to be better than you at that job.
yes,
So yeah, how do you know that? Well, they should be bringing new ideas, and you want them to be bringing ideas that you haven't thought of. And as the leader, where I think as leaders, we often get in the way of ourselves is, again, going back to being able to be humble and being able to receive that feedback, right? And those other ideas that we're paying the people so much money to generate in the first place, right? And so I think where us as leaders, where we can be really powerful is just trying, we know they're going to bring great ideas. We got to be accepting of that. We got to really stand those people up. And
yeah.
I'm sure you've done that in your business. And that's why you've been so successful.
Thank you.
I wanted to circle back around because you said your assistant was your first hire, and it was really about scheduling. So thought process behind that's really beyond hiring an underwriter or an asset management person. It was just that you felt that that was your biggest leverage point. And kind of how did you come to that determination to say, like, that has to be my first hire?
I was looking at what took the most out of my time that I could easily outsource. And
Mm-hmm.
I when I'm not, at that point, I was receiving all the emails directly from investors who wanted to talk with me. I'm not reviewing those emails anymore. And it occupied my time. I'm also not great at scheduling. It's There's a lot of moving pieces there. And it became unsustainable because I
Mm-hmm.
would spend a lot of time going back and forth with investors, trying to schedule something um, on the calendar, and I needed to free up this time. And that's basically why I hired the assistant. And they also helped a little bit with social media and postings. And again, these things took a lot of my time, and I could offload it so I can focus on bringing new deals, on actually meeting with investors, overseeing asset management. These are the technical things that I could offload that
Mm-hmm.
freed up my time to do things that basically had higher value to the business.
Absolutely. Yeah, you're always trying to move to your highest
Yeah.
and best use, as we said, right? And so
Yes.
you did an analysis to understand, and I'm sure because you went to MIT, I'm sure there were lots of spreadsheets involved and probably some complicated formulas. And you came down to, man, I'm spending all this time, scheduling these. And I love the point you made that it's easy to outsource.
Yeah.
Right? Because it was something that you could do quickly. It was, some low-hanging fruit there, and you're able to get that off and focus on bigger and better things. So I wanted you to share that because I want people to have kind of that mindset of how do they start to say, understand where their leverage points are and how they can really start to get some of these busy tasks off your plate, right? Because there's a big difference between being busy and being really productive. I think we
Yeah.
get trapped in that sometimes. It can feel good to do a lot of things, but at the end of the day, did you really move the needle? And I love how you're always looking to make sure you're spending
Exactly.
your time doing the most valuable things.
Yeah.
Awesome. So I think rounding out the questions, really what I want to know now is you've gone from zero to, going to be a billion this year, huge growth within your company. What's on the horizon for Blue Lake Capital? And where do you see your company, whatever, going from here?
Yeah. So we have one office in the Boston area, and that office is focused on high net worth individual investors and family offices. The office in LA is a little newer, and the focus there is institutional investors. And the goal is to develop another arm to Blue Lake, and that would be institutions, pension funds, U.S. funds, foreign funds, and one LPs that are joining, deals, and that would be basically part of the growth of the company. And then actually tomorrow, today is April 13th. This is probably going to be released at least a week from now.
Yeah.
So by the time you guys are hearing me, we're already going to have our new multifamily fund launched. And so that's also something, another part of the growth for us. And so I'm not so much hung up on the numbers in terms of, crossing the $1 billion. But in terms of the growth is really opening up the investments to collaborations with institutions, alongside also, working with our investors to keep bringing them deals, to keep providing them with new investment, vehicles like the Blue Lake multifamily fund that we're launching. That's basically my focus. That would be the focus in the next 12 months.
Exciting. Well, a couple of huge growth points there. So I'm excited to revisit this and see how that all developed and hear some of those new lessons learned. But well, Ellie, before I let you go, I'm going to take you through our keys to success round. Yeah, 4 more questions I want to ask you. The first one is, if you were one of your investors and you were going to place money into a deal, and you could only ask the sponsor one question, what is that one question?
That's easy. What's the debt structure? Easy. I want to know if the rate is fixed, adjustable, if a cap has been purchased, if it's an adjustable rate, what's the LTV, make sure it's conservative. Definitely the debt structure.
Well, true to form, as you said, the focus is on debt and bad debt. So I love it. What are you most proud of in your career?
Actually pulling myself out of poverty. I grew up very poor, and I was cleaning buildings when I was 11 years old, kind of around 10, 11 years old, to help my parents make some money. And so fighting hard to get to law school back in Israel, and then fighting even harder to get into business school here in the US and starting a new life. When I moved here, even though I was an attorney, I was still in a lot of debt that I was carrying from past life. And so the thing that I'm most proud of is pulling myself out of that cycle, and able to help the people that I love the most.
Yeah, I mean, what an accomplishment and what an inspiration for others that are in that position now. And look how far you've come. So absolutely something to be proud of. What is a book that everybody should read?
The one thing I highly recommend, it goes back to one of your earlier points about focusing on the one thing that, if you'll do it, then everything else is becoming easier. And that's the approach. I actually read that book when I started to shift into more of a corporate, or kind of a more structured company. And I realized that I'm spending a lot of time on certain activities, and then I started to I either hire for these positions or partner with others to make sure that someone else is taking on that part. So the One Thing by Gary Keller is a book that I highly, highly recommend, especially for syndicators and business owners.
Yeah. And I will echo that, because similarly, that book, amongst some other things, set me on a similar path to grow and
Yeah.
scale the team. I think that, and then like Who Not How, were 2 books I read, back to back. They were like, yeah, I gotta We need to really grow this thing. So yeah, 100%. The One Thing is a fantastic book. And last but not least, what is your number one key to success?
Persistent. Just never ever give up. There's
Mhm.
always a way around things, and even if they're failures, if you look at, that's fine. If you look at the most successful businessmen in the world, their path was not one success after the other. You got to be willing to deal with hard times and keep pushing forward, being persistent and staying true to also who you are. But I would say persistent is the number one thing.
Yeah, 100%. And it's funny. I think I probably say this on almost every episode now, but it just keeps happening. We're like, I bet if I looked back, like 90% of the people on this show, that's their answer. If you ask what their key to success
Yeah,
is. And I think it just rings so true. Rings so true. Persistence and getting through the hard times and just showing up when it's not easy. So
yeah,
appreciate your
absolutely.
perspective with everything you've shared today. Just a wealth of knowledge. I think some great insights into how you look at deals, how you've grown your business, how you've scaled your team. Really powerful stuff. If folks want to get a hold of you or learn more about what you're doing and Blue Lake and your fund, how can they reach you?
So you basically can find all the information about us, about the current offerings, and the new fund that we've launched. If you go to bluelake-capital.com, and that's it. And if you want to reach out to us,
Easy.
you can email us info@bluelake-capital.com.
Awesome. Well, we'll make sure all that's listed below so folks can reach out to you, Ellie. And again, thank you so much for coming on the show. And I hope you have a wonderful rest of the day.
Thank you, Ken. It was a pleasure and always great seeing you.
Thank you. Yeah, you too.